And now for our weekly economic roundup, I'm joined by the ABC's economics correspondent, Stephen Long. Stephen, there's been another massive injection of money into the banking system by the European Central Bank. How have they done it?
Another 530 billion euros going to the banks from the European Central Bank, and what they call them their long-term refinancing operation. And basically what they've done is they've offered the banks money at 1% interest rate for 3 years, and the banks naturally have taken that up in large measure. That brings to more than 1 trillion gross the amount of money that they've given the banks through this facility since December. But guess what? Guess what the banks are doing with it? They put most of it back with the central bank on deposit. So either there's no demand for it at this stage, or they're deciding what they're going to do with all the cash.
Well, because they're being so conservative in their lending practices at the moment, of course. But it's extraordinary that the amount of money is actually more than what the Stability Fund represents in the Eurozone.
It's an extraordinary amount of money that they've given to the banks, and really this is the backdoor way of trying to stave off disaster. And you have to say it has, for the moment, staved off disaster in a way that that Stability Fund never did, really, Emma. I mean, that was pretty much a damp squib. It didn't work. This is working in the short term. Basically, the banks couldn't borrow money in the private sector last year, and the European Central Bank stepped in. So now they're borrowing money. They're also buying government bonds of the troubled countries, and that's pushing down the interest rates, meaning that that huge debt load that those massively indebted European nations have is becoming a little bit more sustainable for now. But you'd have to say it's a time-buying exercise. It doesn't deal with the fundamental problems of that massive debt. And something else that you alluded to, and that's the massive deleveraging. They're conservative in their lending practices, but borrowers are conservative too, because basically if there's not much demand and Europe's in recession, then the money won't be lent. So whether it works in the long term, that's a big call.
And where is the European Central Bank physically getting this money from? Is it printing new money? Is this an exercise of quantitative easing, as they call it?
It's coming out of thin air, Emma. It's just keystrokes. I mean, they expand their balance sheet basically by lending the money. And money comes back from the banks in the form of collateral. That's how they generally work these things. But basically, they're massively expanding the balance sheet of the European Central Bank. So effectively, they are creating money.
And so just very quickly, what does this new flood of European money in the system, what are the implications for us?
Well, it's bad news for Australian exporters who've been struggling with the high Australian dollar. We saw commodity prices ease this week because China isn't looking quite so rosy with its manufacturing industry, and there were some concerns about the US. That usually pushes down the dollar, but it hasn't. It's gone the other way, because if you're borrowing money at 1%, if you're a bank in Europe, you're looking for somewhere to invest it with a high interest rate, and guess what? Australia, you can get 5% plus. Carry trade money coming to Australia. It's our tourism industry, our education industry, our manufacturing sector. Good if you're travelling overseas, though.
Stephen Long, thanks very much. Have a good
You're
weekend.
Welcome.